We all know that over the long run, stock markets go up. Not all stock markets, but most. Even the Japanese stock market recently surpassed its all-time high that was set 34 years ago. And now in this video I want to focus on the US market and the S&P 500 index specifically. The S&P 500 is arguably the best performing stock market the world has ever seen. And I recently came across a couple of headlines and also a video by fellow investing YouTuber Sven Carlin, who claimed that the S&P 500 could hit the 10,000 point milestone rather soon. And for context, today, as of the time you're recording this video, the S&P 500 stands at 4,983 points. So let's just round it up. Let's say the S&P currently trades at 5,000 points. So can the S&P 500 hit 10,000 points by 2030? That's in 5.5 years. This is what we are going to focus on in this video, and we'll take a super rational approach. So without further ado, let's get started. Alright, so in the introduction of this video I was referencing a video by Sven Carlin. And quite frankly, I don't think this video was particularly well researched. He was talking a couple of factors that are driving stock markets higher or lower. And one factor he was specifically focused on were interest rates. And while surely interest rates are a driving force in the world of stocks, especially over the short term, there's this famous Buffett saying that interest rates are to asset prices what gravity is to an apple. Well, over the long term, there are other factors that investors have to take into account. So as I said in the introduction, in this video, I want to take a different approach, a more rational approach based on actual data. And I would claim the scientifically correct way to assess whether a goal of 10,000 points by 2030 is actually realistic. Just on a side note, I've actually considered whether I want to add a tagline to my YouTube channel. What I have in mind is to call myself the voice of reason in an investing world of noise. Let me know what you think of it. All right, just to get back to the topic of this video. So you have to understand the driving forces that are moving stock markets higher over the long term. Obviously, over the short term, anything can happen. And the driving forces of, say, returns over any week, month, or year are completely different than the driving forces over decades. Because over the long run, say over decades, the driving forces can be broken down to the components of the so-called total shareholder return. And I've actually come across this beautiful chart here that looked at the driving forces of the annual returns of the S&P 500 between 1960 and 2023. And at the top of the chart, you see the four components that I was alluding to earlier. So we've got a change in the valuation multiple. We've got the impact of share buybacks or issuing new shares. We've got earnings growth, and then of course you also got the return investors can get from dividends. And just to show you one possible scenario that could get the S&P 500 to 10,000 points by 2030. Let us look at this chart here that I created myself. So as I just said, let's just assume we are in the midpoint of 2024. This means there are 5.5 years left until we reach 2030. I was then just using $100 as the current earnings power of the S&P, which number we actually put in here doesn't really matter. So in this scenario, I assume that the earnings of all S&P 500 companies combined double. I assume that the current PE multiple the S&P is trading at, 27 times earnings, is going to stay flat. And I was assuming that companies are buying back some shares over this 5.5 year period. Well, and if you combine all of these factors, well, then you get a compounded annual return of 14.7%, which gets you slightly above the 10,000 point mark. Obviously, we could also assume other inputs here. Maybe the earnings grow at a slower rate, but the valuation multiple expands a little bit. Maybe companies are buying back shares at a faster rate, but we'll get to this in just a second. So let's assess how realistic those scenario inputs actually are. And as I said earlier, we'll do that by looking at some actual historical data. Before we do that, maybe we can assess how likely this outcome is by using a rule of thumb, the rule of 72. So what this rule is basically doing, it gives you an idea of, given a specific rate of return, how long it would take you to double your money. And as I said, this is what we are looking at. Can the S&P 500 double over the next 5.5 years? So if we, for example, divide 72 by 12, this is a fairly straightforward calculation because we get a round number. Well, then it would take the S&P 6 years to double. Not quite our goal, right? So let's increase the return that we are assuming. Let's go for 13%. And with this rule of thumb, which again is not precise math, but it gets you pretty close results. Well, then we could witness a double of the S&P over 5.5 years. Is this possible? Of course it is. We'll get to a paper by Michael Mauboussin in just a second. And in this paper, Mauboussin, for example, looked at the period between 2012 and 2021. And over this 9-year period, the S&P actually generated a compounded annual return of 14%, which is of course great. The long-term return of the S&P 500 is a little lower, of course, or maybe I should say significantly lower. It's more like 9 to 10%, but we'll get to this later in the video. So let's get back to the different components of the total shareholder return. The first one is the most important one. It's the earnings growth. And clearly we are here not looking at the earnings growth of a single company, but at the basket of all 503 S&P 500 companies. So again, I was actually doing a lot of research for this video, and I was looking at some S&P Global data to figure out the current earnings power of the S&P 500. Basically, S&P Global allows you to download this massive spreadsheet that includes lots of, data, and it is actually updated every quarter. So we have numbers that are super up to date as of March 31st, 2024. And the spreadsheet includes everything from earnings to revenue to share buyback data, dividend yields, book value of the S&P 500 as a whole, and a lot of historical data. Well, and to assess the earnings growth needed for the S&P 500, I was looking at the current earnings power, which stands at 189. I think the way you have to think of this figure is it's kind of like a look-through earnings figure. And obviously, we now have to consider, what is a realistic earnings growth rate that we could assume over the next 5.5 years? And quite frankly, it really wasn't easy to get your hands on this data because the S&P Global spreadsheet didn't include like the final number that I was looking for. So what you can actually quite easily find is the year-over-year growth rates of the S&P 500. I'll show them on screen for you right now. And you can actually also figure out what the mean growth rate was and the median growth rate. But quite frankly, those numbers are pretty much insignificant, irrelevant to us because the mean and the median have absolutely nothing to do with the compounded annual growth. I think that's important to understand. And as you can see here, the growth rates of the S&P 500, the annual growth rates also fluctuate quite heavily, which is one of the reasons why the median and the mean aren't really helpful here. So in some years we see growth of 40%, in some years we see a decline of more than 50%. Well, and the mean growth rate was 22.9% and the median growth rate was 10.7%, which is more realistic, but as I will show in just a second, still quite off. So a better data set to look at would, for example, be the paper that I cited earlier from Michael Mauboussin. So he was also breaking down the return of the S&P 500 between 2012 and 2021, and he has shown that the earnings grew at a rate of 6.7% over this 9-year period. So that would be one possible input that we could use for our final calculations. Well, luckily, I was digging really deep into the S&P Global spreadsheet, and I was finding the earnings from continuous operations of the S&P 500 going all the way back to 1988. And as the spreadsheet also includes the earnings from continuous operations from 2023, I could figure out the compounded annual growth rate to get from 23.75, so that's the earnings in 1988, to 192, that's the earnings as of the end of 2023. Well, to get from the first number to the second number, earnings of the S&P as a group needed to grow at a rate of 6.16%, so that's pretty close to the 6.7 compounded annual growth rate that Mauboussin was calculating for the period between 2012 and 2021. So based on all of this, I know this was a lot, and our assumptions for the S&P over the next 5.5 years, I was assuming earnings growth of 6.3% compounded annually, which would grow earnings from 189 to 265 in 2030. All right, which brings us to the second component of the total shareholder return, the PE multiple. And what I should say is it's the change in the PE multiple. Does it expand or does it compress? So the first thing we should do is take a look at the current PE multiple. I was looking at the S&P Global dataset, and according to this data, as of late March 2024, the S&P 500 is trading at a PE multiple of 27. Well, and in this context, one may address interest rates because obviously interest rates will influence the rate of return that investors are demanding from stocks as an asset class. Because if interest rates are lower, stocks may deservedly trade at a higher PE multiple. And if interest rates are higher, obviously investors should demand a higher rate of return, which would lead to lower PE ratios. So again, let me show you some actual data. So what you can see here is the PE ratio of the S&P 500 over more than the last 100 years. As of today, the S&P trades at a PE multiple of 26.96, which is well above the historical mean of 16 times earnings and the historical median of 15 times earnings. You may also want to consider the Shiller PE ratio. If we use this metric, the S&P currently trades at a PE multiple of almost 33. The median is 16 times earnings and the mean is 17 times earnings. What I also wanted to show you is the chart over shorter time periods. So this chart here shows the PE ratio of the WU ETF, which tracks the S&P 500 over the last 5 years. What you can see here is that we are slightly above 25. This is the chart over the last 10 years. And this is the chart over the last 20 years, and also including the 20-year median of 21.2x. So why am I showing you all of this? Well, I think it shows that the current PE ratio of the S&P 500 seems to be rather high, at least compared to its historical average and mean. So I was going for a PE multiple that is slightly above the 20-year median of 21.2. I was going for a PE multiple of 22, which of course means that the change of the PE multiple will be a headwind for investors, because the current multiple the S&P is trading at, it's 27 times according to the S&P global dataset. Well, it will have to go down. Which brings us to factor number 3, the development of the share count. We can keep this one fairly short. It's not that easy to actually get your hands on this data. We'll have a look at the Mauboussin paper. And in this paper, he actually concluded, quote unquote, "We include stock-based compensation only since 2006. The first year the Financial Accounting Standard Board required companies to disclose stock-based compensation on the income statement." So my understanding is here that you actually have no historical data here. You have no 100-year period to look at to determine, well, are companies over the long run issuing new shares or buying back their shares? On average, of course. So we have to work with what's available. And the first thing that we may reference here is, again, the Mauboussin paper. I was referencing it earlier, and the calculations he did for the period between 2012 and 2021. And for this period, Mauboussin calculated that the S&P 500 companies as a whole were reducing their share count by 0.7% a year. But quite frankly, if we look at the bar chart that I was showing you at the beginning of the video, we can see that a share count reduction wasn't always observable. So again, that's the part of the different bars colored in blue or light blue. And as you can see, during some years, the S&P 500 companies as a group were also issuing new shares. So what do we do with all of this? Well, we have to make a decision here. And I was just going for the development of the share count that Mauboussin was calculating for the period that I referenced many times now already. I was assuming that over the next 5.5 years, the S&P members will reduce their share count by 0.7% annually. Which brings me to my conclusion. Let's bring everything I highlighted so far together. So what you can see here is I was plugging in the development that I was just presenting to you. And if we combine all of this, the development of earnings, which will go up from 189 to 265, a compounded growth of 6.34%, the development of the PE multiple, which will actually compress over that 5.5 year time period, well, that translates into a compounded return of 3.66%. And the development of the share count, again, companies, that's what I am assuming, are going to reduce their share count. Well, if you combine all of this, you get to a compounded annual return of the S&P 500 of 3.21%, which means that the S&P will increase by a factor of 1.19x, which is definitely not enough to get to 10,000 points. To do that, you would need a multiplier of 2x. But again, as I was just highlighting, the development of the PE multiple alone was a headwind of 3.6%, compounded annual, negative 3.6%. So let's just assume the PE multiple stays flat over the next 5.5 years. What does this do to our expected annual return? Well, if we do that, we get to a compounded annual return of 7.13%, which again is not enough to get to a double. As we highlighted earlier, to do that, we would need a return of roughly 13% compounded annually. So what does it mean? Well, it means that personally, I wouldn't want to bet that the S&P 500 will get to 10,000 points by 2030. But let me be clear here. That's not a forecast. Of course, the S&P 500 could get to 10,000 points by 2030. That's a fairly short time period. earnings could grow at a faster rate, maybe the PE multiple may expand, maybe both of this happens at the same time. But if we are looking at the historical data, this is not something you should expect. In fact, you should expect quite the opposite. You should expect that the PE multiple over time will probably come down a little bit. The earnings will probably grow on average at a rate of around 6% a year. We're not sure if profit margins may come down, which obviously will impact the earnings growth. I've heard many people say this, that now that we are entering a different interest rate environment, profit margins may come under pressure. And I guess the whole purpose of this video was to set proper expectations. There's this quote or saying that misery comes from having wrong expectations. And I guess this was the sole purpose of this video, to set your expectations right and to make you understand that the S&P hitting 10,000 points by 2030 is maybe not the most likely scenario. Does this mean you should not invest in the S&P 500? Well, no, of course not. If you have cash left over, the worst thing you could do is just letting it sit in your bank account for 5.5 years, because that money is definitely going to lose real purchasing power. But you have to understand that the stock market on average goes up, but it doesn't go up by a rate of 14% forever. This may happen during some periods, but during other periods, the stock market is also completely flat. And if you want to get a return of, say, 14%, well, the only way to do this consistently over the long run is by actively picking stocks. The S&P 500 is not going to give you a return of 14% over the next 50 years. I don't know this for sure, but just looking at the historical data set we have available, that seems like a fairly unlikely outcome. So what I also wanted to show you in this video is this chart here from Aswath Damodaran. What I wanted to highlight here is the calculated annual real return of the S&P 500 between 1928 and 2023. And as you can see, the S&P 500, including the return of dividends, returned a real return of 8.4% over this almost 100-year period. Speaking of dividends, I was earlier showing you the formula for the total shareholder return, and one component that we didn't address yet is the dividend yield more specifically. And in this context, let me once again just show you some data that may be helpful to, again, set your expectations properly. So as of March 2024, the dividend yield of the S&P 500 stands at 1.4%. And this chart here shows you the annual dividend yield of the S&P 500 in any given year, going all the way back to 1990. So to assess the total return that you may expect from the S&P 500, you should also take into account the dividend yield that you would get if you invest in an S&P 500 ETF. And this dividend yield would obviously not be reflected in the development of the price of the S&P 500. So this is what we were mainly focused on when we were discussing whether the S&P could realistically go from 5,000 points to 10,000 points. Now your total shareholder return also takes into account the dividend. And I guess that's it for today. Let me know if you enjoyed the video. Take care.